one of the first few places to get the temperature of what's going on in an economy is the debt market. So let's track the yield curve. Of course, you've heard about portfolio investors exiting the Nigerian market, again, due to global pressures on emerging markets and frontier funds since the middle of the year. So that is the sensitive end of the first quarter of the year. So that's already in the news. But again, if you want to track what's going on with the political and the political economy, let's get a track of that. Eromosele Aziba from Afrinvest is one of the investment analysts, is raising the curtain for us this week to start this conversation. Good morning.
Good morning,
It's good to have you. Hope you had a very nice weekend.
Yeah, well, we tried to rest.
Yeah. Let's track the stock market story, or the equity story is already on the street. But let's cross the street and say hello to the folks at the debt market. What does the yield curve tell us right now where we are at the local market?
Yes. So last week we had a marginal 5 basis points increase in terms of average yield, certainly at about 13.9%. But since the start of the year, the trend we've continued to see in the yield curve is some sort of normalization. You know, if you recall back last year, we had rates at the shorter end of the curve a lot higher than at the longer end. So since the start of the year, we've seen that sort of moderation in the yield curve here. We've seen yields at the longer end of the curve trend higher than yields at the shorter end of the curve, which is the normal situation that you'd expect on the yield curve, especially considering the fact that the longer into the future it goes, the higher the risk that the investors are taking up, which is one of the reasons why you tend to see yields at the longer end of the curve higher than at the shorter end of the curve.
Am I surprised? Wednesday last week, the debt office was doing a reopening of bonds at 14%, 14.3%. Previously, well, still around 13.8%. We're almost a year into that announcement, September last year, when the Ministry of Finance, the Central Bank, and the debt office says, look, we're going to restructure the entire thing and head to a single digit. Almost a year after, where are we if the debt office is still doing 13.8 in reopening of existing papers?
Well, it's the situation we're seeing there is in line with current realities in the market. Considering the fact that we are seeing higher interest rate hikes from global markets, global systemically important central banks, with the higher rates you're seeing in the global market, it's having an impact here on our own local market, as investors will be demanding a higher return in terms of investing in the market, and this is one of the things that we've seen play out in local markets. Also, if you look at inflation, for instance, even though headline inflation continues to trend lower on a year-on-year basis, the impact of that high base from last year has started to thin out, as we've also seen pressures from food prices as well that could ultimately lead to inflation possibly trending slightly higher closer to the end of the year. So considering all these factors and the various risks which still remain in the market, we're seeing investors price this into the evaluation of this.
So our plans from September last year to see a lower yield curve at the local market, giving us an advantage to go back to the Eurobond market, $2.8 billion or so to have on paper for this year. Does that look like the environment is heating things up from under, and it looks like that single digit does not look very feasible in the near term?
Well, in terms of looking at domestic markets, hitting that single digit doesn't look feasible at the moment based on current realities in the market. If you also look back to the MPC meeting that was just concluded, you know, as at the start of the year and even late last year, there were already speculations that we could possibly see a rate reduction within the first half of the year, but after...
That's out of the window.
After 3 meetings...
Out of the window. It's not going to happen again.
I mean, after 3 meetings, that hasn't been done, and the reasons are quite obvious. In a situation where you have higher risks from the external markets, you need to keep your own instruments attractive enough for investors.
So this is keeping it attractive at about 13.8, 14% by the debt office.
Essentially, that's the situation that we have there.
Well, okay, so aside external considerations, what else are investors pricing in here for the Naira papers?
I mean, for investors, you could also look at the risks in the environment, maybe tied to political risks as well, even though the impact of that is more visible in the equities market side of things. In terms of looking at the stability in the polity, we believe this is another factor that investors could be pricing in the evaluation of these instruments.
Again, if you read the body language, of course, the offerings, or by the debt office so far in terms of volume and in terms of rate, what does that tell you as an investment analyst?
I mean, in terms of volumes, we still expect to see the similar volumes to what has been prescribed in the bond calendars, because there's that need to still finance the domestic borrowing bit of the 2018 budget. Let's not lose sight of that. But in terms of pricing, we expect to possibly see higher rates in the market, like I said, as investors would want to demand a premium for taking these investment decisions. And even going back to the MPC meeting, a quite interesting development from that meeting was there were about 3 members that voted in favor of raising rates. So this, even though we don't necessarily expect that rates will actually be raised before the end of the year, a case can be made for raising those rates. So for an investor also looking at that, when you price that into your valuation of this instrument, it's highly likely that you demand for higher rates.
That's a signal, because whether you keep rate or whatever, investors look for comments by members and how they vote.
Yes.
The voting pattern to say, look, there's a signal in here. And the central bank governor in the communique also said there was a strong case made by members, by some members, for a rate hike.
Yes.
So you think investors take that on board?
Yes, definitely. I mean, investors will be looking at signals or guidelines that could potentially give a sense of where the market could be going, and that's one thing that investors pricing into investment.
So when investors heard from that communique a Tuesday ago that, look, government needs to, there's so much liquidity in the system, try to prevent inflation, coming back very strongly from where we are presently, these are some of the things that what investors take to the market.
Yes, definitely. These are considerations that investors take into account when investing in the market.
When they're talking to you right now, what was their chief consideration right now as we speak?
I mean, for investors, for domestic investors, we still have players that want to play in the equities market. I mean, with the depressed performance that we're currently seeing in the market, we still view opportunities there for investors to take advantage of, especially ahead of the release of H1 results, especially from the banks, the tier 1 banks, which are expected to still turn out positive results. But for us, we recommend a balance of play between both the fixed income market, fixed income instruments, and equities. Fixed income definitely for capital preservation, whilst equity markets present higher upside for you, there's also that downside that you could lose some of your money. So to make up for that shortfall, that's why you'd have that fixed income base.
What are investors buying now? Hope or growth?
Well, I mean, I think it's a mixture. It's a mixture of both. In the sense that trading activities in the market, we've seen a lot of trading activities.
Should I buy on hope, sell on growth, or buy on growth and sell on hope?
Well, for investors, it's the view that there's going to be growth, essentially. So they are hoping that there will be growth. So essentially, it seems like a combination of
looks like
of
same
both
side
factors.
of the same coin. Two sides of the same coin.
Essentially.
Hope or growth? When investors hope in the market, what are they hoping for? They're hoping that the political environment will not get too hot, right?
Yes, I mean, that's definitely a key concern. But
yes,
going by historical trend, how the political environment has been, a lot of investors will not even wait till the actual campaigning starts. They just want to sort of exit the market. I mean, given the fact that foreign portfolio investors remain the major, in terms of moving the market upwards, remain the major players in the market historically. For foreign investors, once it gets closer to that political period, I mean, we've already started seeing the reversal from foreign players in the market. And we believe a lot of domestic investors would also just follow this trend. So, I mean, getting closer to the elections, what we would see will be a lot of speculative trading in the market, maybe investors coming in for some short-term positioning, just come into the market, make your capital gains, and exit. But I mean, for an investor who has a longer investment horizon on the equities market, I mean, now is quite a good time for you to come in. I mean, considering current prices in the market, we have a lot of these instruments trading closer to their 12-month lows, and even in terms of their valuation, somewhat underpriced relative to historical pricing as well, which also makes a case for investors.
What's the message from the Eurobond market?
Well, from the Eurobond market, this last week, we started to see a lot of activity across the SSA Eurobonds. We started to see more buy interest following the initial, would I say, knee-jerk exodus by foreign investors. We've started to see that come back into the market. I mean, because these instruments still remain quite attractive for investors to take advantage of. I mean, maybe a factor that investors could possibly be looking at is tied to comments by President Trump as with regards to the hikes in interest rates. I mean, the Fed still remains somewhat independent of what developments in the political space, but we know these are factors that investors could also be looking at. But above all, I mean, these sub-Saharan Africa Eurobonds still remain quite attractive for investors and present good opportunities, which is why we've seen some buy interest over the past 1 to 2 weeks.
So you think the initial fever over make America great again, whatever, the 4.2% GDP for Q2 in the US, the whole thing about the trade war is getting investors to take a second look at the emerging markets and frontier markets and say, well, maybe we shouldn't have rushed out the way we did. Let's tiptoe back a little bit and begin to look at this as whichever way you look at it. What's the average rate on Eurobonds now, both sovereign and corporate? I think around 7.
For sovereign, we have about 6.5% thereabout, and then for the corporate Eurobonds, it's about 1 to 1.5% higher than sovereign.
7.2 thereabouts. So we still, that's still attractive.
Yes, I mean it's still attractive for investors to take position, and if you also consider the improvements in terms of FX liquidity in the market, a situation where you would come in and then when it's time to repatriate your funds, you might be stuck. I mean, worries with regards to that have sort of dissipated with the increased oil production, rallying oil prices.
But you think if we go hit the market with $2.8 billion that we're planning between now and October, technically we should do this by September to all intents and purposes. But we've always gone late to the market. Do you think we should be able to do 2.8 billion?
Well, I mean, the Nigerian instruments still remain attractive. So yes, we might be able to raise these funds now. The key question would be at what rate are we going to be raising this? Will it be higher than we've seen in the prior auction?
In the first quarter of the year.
Yeah, in the first quarter of the year. I mean, with the coming in the third quarter, we were closer to the elections period. We know the impact that this has had on the market.
A little bit of premium.
Exactly.
You're hinting at a little bit of a premium.
So investors most likely price this in as well.
A little bit of a premium.
Well.
Thank you. Let's leave it there for today. Thank you for raising the curtain on the conversation in the markets this week. Ramosele Aziba, one of the investment analysts at Afrinvest. The stock market is where we're going to finish that off in 2, just after the break.